Hello and welcome to another edition of the Video Market Update. My name is Beyond Dale, and on the podcast, we spoke about the 1800 level. And why is that important? Is that this level was a previous low. As you can see, the market went up, came down, went up. It breached this intermediary low, which wasn't that positive. And what I had said was that if the market breaks down below this low, we could see a lot of automated sell signals come in, and that would be bearish for the market. But the market actually came down close to that level and rebounded, which is pretty encouraging for the bulls at least. So the market is currently on an upward trajectory. Now, what we need to keep an eye out on the S&P 500 are certain key levels. The key level, the first one is the 1800 level, as I said, this 1800 level, and the previous high here at 2020. If we see the market climb above 2020, that will be very good for the bulls and would signify that this market, the rally, may have some more legs to it. We're coming on a seasonally strong period it's the strong period really in late November, December. So it's early days yet, but the end of the year is normally pretty strong for stocks, and if we can climb above this 2020 level, that will be very bullish for the market. If we cannot, and the market somehow does not close above this level, that may be bearish. And then what will confirm the bearishness is if we close below 1800. So as an investor, those are the key technical levels that you need to keep an eye out on the S&P 500. Moving on to the Dow Jones Industrial Average, we see that the market and the critical area in this market is 15,400 right here. Okay, so the market did break the intermediary low but has recovered quite nicely. And similar to the S&P 500, if we close below this 15,400, that will be quite bearish. And on the Dow, we want to see the market close above 17,400. That would make the argument that this market would have more legs. Now, keep in mind that the Dow Jones Industrial Average is just an average of 30 stocks. So that's why we concentrate on the S&P 500, because it's a broader measure of the strength of the market as opposed to just the Dow with 30 stocks. Because what you find sometimes is that the Dow can lead, and the Dow can essentially get ahead of the S&P 500, and when it realizes the S&P 500 is not with it, then it can drop quite dramatically. Now, the other average is the NASDAQ, and we see that the market is in a pretty strong uptrend, whereas the level on the NASDAQ, the critical level, is all the way down here at 3,400. So the market the retracement was very shallow in the NASDAQ, and we want to see the market close above this 4,100 level. That will be pretty bullish for the market. Now, on the podcast, I also spoke about the threat of deflation, and I highlighted the Nikkei 225. And what I had said was that if we enter a period of deflation and falling prices in the US or in the world economy, essentially, what would that mean for stocks? Would it mean that the stock market could top out and enter a long bear market? There are a lot of market participants that are calling for that very scenario to play out, and it has played out already in Japan. Now, this is a monthly chart of the Nikkei 225, which is the major stock index there in Japan, and we see this level represents 1985, and we had a pretty strong bull market up to 1990, and the market topped out at 38,000. This is price on this axis, this is time. Okay, so in 1985 to 1990, roughly 5 years, the market topped out at 38,000, fell almost 50% initially, rallied a little, and then fell all the way down to 15,000. That's more than a 60% decline in the market. And ever since, the market has been in a long bear market. And a bear market is a period of low highs, lower lows. And you see the highs have not been very high. Every high is lower than the previous high. So this high is lower than this one, is lower than this one, lower than this one. So we're in a bear market in the Nikkei. And the question is, during this period, Japan experienced quite significant deflation. And the question is, what would happen to the rest of Europe and the US if they entered a period of deflation and we entered a 25-year bear market? That would be very negative for stocks, and a lot of investors would be in trouble because their strategy for the stock market is just a long only strategy. And if you have a long only strategy, meaning that you only make money if stocks go up, then you could be in for some trouble if deflation really takes hold. Now, I know a lot of folks aren't saying that it will take hold. They actually believe inflation would take hold. But what the markets are telling us now, and this is not a prediction, is that we find that, let's take a look at some commodities. We find that oil, let me take a weekly look at oil. The oil market is declining. Charts are taking a while to update. But from the high, let's look at a monthly chart. From the high that was made in 2008, oil fell, it recovered. And the question is, would this move down that started in June or July, would this move down continue all the way down? Taking a look at the gold market, we see that the market, this is a weekly look at gold. The market was in basically a 10-year bull market. Market went up and now is trending downwards. And the key level to look for in gold is this 1200. If it breaks below 1200, that could be very bearish for gold. So would that decline? And if we find these assets declining, could we be entering a deflationary environment? That is the $1 million question. And I advocate, whether you're in a bull market or whether you're in an inflationary environment or a deflationary environment, you should position your portfolio for either and have a strategy to deal with either scenario. And that's essentially why we follow what the market is doing. You should have a strategy for when the market is going down and when the market is going up. And what we do here for our managed account solution is that we have strategies for whatever scenario. So if we have inflation, we will take advantage of a rise in the prices. If we have deflation, we will take advantage of a decline in prices. And that's how you deal with an environment that may be negative for stocks. But to summarize, currently the stock market is in an uptrend, and I will always give you updates when that trend ends. If you want some more information about dealing with deflation and position your portfolio for greater diversification, you can click the link below this video or head over to smartinvestorcentral.com slash manage account, and you can get some more information. Okay, this is Beyond. Thank you very much for listening, and have a good investing week.